This house in Everett, Washington is listed at $525,000, and we're going to walk through a real mortgage quote to answer the question, how much income would it take for a lender to approve you for a loan on this house? If you came to a lender and said, I want to buy this house, would you get approved if you were making $80,000 a year? Would you get approved if you were making $100,000 a year, $120,000 a year? How does it work, and would you get approved? So one thing that is obviously going to depend on is your down payment or your loan amount. And so we're going to walk through two different down payment scenarios. One where you are putting 3% down and one where you're putting 20% down. So we'll look at a range of maybe you're coming with just a small amount of cash and one where you're coming with a pretty sizable down payment. And then if either of those aren't exactly where you're at, hopefully you can just get a sense of what you would expect. This is going to be a real mortgage quote that we are looking at. We are a local mortgage broker based in Bothell, Washington. And so it is a real quote we would pull on the house. It's not the exact numbers that you will see. It's not the exact interest rate you'll get, but it should be a pretty good estimate and give you a better idea, a more reliable idea of what to expect than just using an online calculator, and hopefully also a sense of why the numbers are what they are. So we'll walk through those numbers first. We'll walk through the quote for each scenario. We'll look at what your monthly payment might be, how much cash you would need to bring all in between your closing costs and your down payment. And then at the end, we'll talk about what that number is that you would need in order to qualify for the loan. So we'll pull up the quote in 1 second and look at that. I hope that's helpful because I know when you're just starting out in the process of looking for a house and thinking about getting a mortgage, it can be really confusing and just stressful and make you anxious looking around at online calculators and not knowing how much faith to put in the numbers they give you. And there's a lot of different elements to the process, and it's all very confusing. So hopefully this will be able to, a concise way to get a reasonable and reliable expectation of what your numbers might look like, and also just learn a little bit about the process, because you might not be ready to quite pick up the phone and talk to a loan officer yet, but you do want to learn about the process. So hopefully by the time you're done with this video, you'll be comfortable to talk to a loan officer. You'll know what to look for, you'll know what they're talking about, and you'll know how to evaluate a loan officer and a lender a little bit better as well. So let's hop into the numbers here. All right, here you can see the two quotes. There's one on the right, which is the 20% down scenario. On the left is the 3% down scenario. And before we start walking through all the numbers, I had to make a few assumptions in order to create the quote. One of those assumptions is that your credit score is 740, because your pricing is going to depend on a few factors. One of those key factors is your credit score. So I assumed credit score of 740. And if you are reasonably close to that, if you're in the 700s, your credit score is not, your pricing, your interest rate, your cost of mortgage insurance, all that's affected by your credit score. It's not going to be drastically different if you're reasonably close, if you're somewhere in the 700s. If you are above 740, it's going to be realistically better. If you are below 740, it's going to be realistically worse. And but it's not a drastic difference if you're in that realm for the most part. Let's walk through the numbers. So let's start with a 3% down scenario. Your monthly payment is $4,145. That's the estimated monthly payment in this scenario. And here are the main components of that. The first is homeowner's insurance of $150 per month. Now, homeowner's insurance, this is an estimate. It's just a number I grabbed because it's a pretty common number that we see for our area at this price point. So it's a pretty reasonable estimate, but it will vary a lot depending on what your area is, depending on who your provider is. If you have just a more expensive provider in general, then that's going to be more expensive. And then what your coverage is. If you are getting if you're getting the whole package as much as possible covered, then it's going to be on the higher side. If you're doing just kind of the bare minimum, it's going to be on the lower side. So homeowner's insurance of $150, taxes of $282. That is drawn from the county website for this property for 2024. So that is the actual number that you can expect of taxes for 2024. So $282 per month. Mortgage insurance of $195 per month. Now that's a hefty fee, and mortgage insurance is a cost you have to pay if you put less than 20% down. It protects the lender against the possibility of default on your loan. And if you put less than 20% down, you have to pay that. Now, this number could vary depending on a variety of things. It could vary depending on what your down payment percentage is. It could vary depending on what your loan amount is. So obviously those are going to be connected, but specifically down payment percentage on its own, regardless of the loan amount, has an impact. If you put 3% down, that's going to be pretty much as high as it could get as far as mortgage insurance. If you put 10% down, you're showing the lender, I'm a little bit less of a risk. There's less data supporting, there's data supporting lower down payment percentage, higher risk of default. And then if you can get to 15% down specifically, that's going to be a huge threshold that can knock down the cost of your mortgage insurance significantly. And then mortgage insurance is very much impacted by your credit score. So that's an area where credit score will have a significant impact. If that seems pretty high for you, I'd be curious to hear what your expectations of mortgage insurance are in the comments. Let me know. Typically, this is pretty high. However, this is the down payment percentage of 3% is pretty much as low. It is as low of a down payment percentage as you can do, so that's why that is so high. And the loan amount is high. If we had a smaller loan amount, then that would be less risky to the lender. But since the loan amount is $509,000 as opposed to $200,000, $300,000, that would make a big difference. The lender that this particular quote is referencing is United Wholesale Mortgage, and they tend to have really good pricing on mortgage insurance. So it will depend also on which lender you end up working with. We are a broker, so we broker to different lenders, and one of the best ones that we broker to is United Wholesale Mortgage. And so this number could be closer to $300. So it's really, it's hefty. It is. It's $195 per month. And again, I'd be curious to hear what your expectations of mortgage insurance are in the comments, what your thoughts are on that. Principal and interest, $3,517 per month. That's pretty straightforward. It's just repaying your loan amount every month, and it's just the amortization of your loan based on the interest rate. The interest rate we are using is 7.375%, and this is a real quote that I pulled today. Again, it's not an exact interest rate that you're going to get. It's not an advertisement, but this video is being made on April 18th, and that should be a pretty good expectation of where we're at right now. I believe the national average for 30-year fixed conforming conventional is 7.4 today. So this is a pretty good estimate for where we're at right now. Monthly payment, this section is just showing, it's basically taking out your taxes in your homeowner's insurance, because those are not dependent on the lender, they're not dependent on the loan, any of that, they're just based on the house. And so it's just showing what your monthly payment is from the lender's point of view. It's just principal, interest, and mortgage insurance. Points or credit, so we're showing credit of $158 per month. Points are a fee you can pay up front in order to get a lower interest rate. So you tell the lender, I want to lock in a lower interest rate over the long run, so I'm going to pay you a little bit of cash up front, and it's going to be worth it to me. Credit is the reverse of that, where the lender says, I will cover some of your closing costs. I'll give you some cash right now if you will take a higher interest rate and pay me more over the long run. So it's an evaluation of what's valuable to you. There's no right answer as far as whether you should pay points or not, or take credit or not. There's no right answer. It depends on a lot of things. But there can be strategic times to use it in a way that sets you up to get a house that you might not be able to otherwise get, to get the payment to what you are able to qualify for, various things like that. Most importantly, your loan officer or your lender should be helping you at least ask questions and think through the questions to consider as you are evaluating whether to pay points or credit. They shouldn't just set you up and not tell you what's going on with points or credit. They should give you a clear idea of what to expect. And then the reason this is not zero right now, basically both of these are very close to zero. For context, in order for points or credit to make any difference at all on a loan of this size. It would have to be several $1,000s to be a noticeable difference. I don't know. I don't have the rate sheet in front of me, but I would guess in order to get it from 7.375 down to 7.25 at this loan amount, it would probably take at least $3,000, probably closer to $5,000. So you could easily be paying $20,000 or $30,000 in points and still just have the rate in the fives, because you can do the math and you can see, well, it's not worth it to the lender, because to reduce it that much would from 7.375 to 5.5 on a loan amount of this size would make a big difference in the money that they're making. So just all that to say, for context, this is very close to zero. It's not really having much of an impact. 30-day lock period. Typically, when you get a loan, you get an interest rate. You have to lock your interest rate you have to at some point tell the lender, go ahead and lock my interest rate in based on today's market. And you can lock it for 30 days. You can lock it for 45 days, 60 days, 90 days. There are various lock periods depending on your lender, but 30 days is pretty typical, pretty common. No prepayment penalty, lender fees of $1,100. Keep an eye out for those. Make sure those aren't getting super high. These are just covering things that go directly to the lender, and those can get pretty high, so take a look at that. Make sure there's nothing egregious on there, but typically that's just some basic costs to the lender in the process of doing your loan. Other closing costs, $10,531. So on top of your down payment, on top of your 3% down payment up front, you also have to pay costs in order to get the loan and get the house. There are two main buckets as far as what those costs are. One of those main buckets is just you have to pay the parties involved in helping you get the loan and get the house. You have to pay for an appraisal. You have to pay for an inspection. You have to pay. You might have to pay a processor to help with your loan. You will have to pay your loan officer compensation. You have to pay title and escrow to transfer the house into your name. Escrow is the third party where all the money comes before it's distributed. So all that is closing costs. And then the other main bucket of closing costs is prepaids, and those are costs you're going to be paying on an ongoing basis. Those are costs that that will just be part of your regular mortgage. There are things like prepaid interest. There are things like your taxes and your insurance, and you just have to get some of those into escrow ahead of time when you're first getting your loan set up, since between the period when you close on your loan and you take over responsibility for the house and the loan, between that time and when you're able to start making payments, you're already responsible for having some of those things paid for. So some of those have to go into closing escrow ahead of time. So those two components are what makes up closing costs. And for this price point, closing costs will depend on a lot of things. One of those being your price point and your purchase price and your loan amount. And for this purchase price loan amount, you probably expect something from $10,000 to $12,000. Anything higher in terms of purchase price or loan amount, then you might end up, if we're talking in the millions as far as purchase price, and high $600,000 or $700,000, $800,000 loan amount, then that number could be closer to 12 to 15, something like that. Or it's just going to depend. But in this ballpark, $10,000 to $12,000 of closing costs is a pretty good estimate. So what that means is total cash to close. All the cash you're going to have to bring into the deal to make this happen, to buy the house, is $27,391. That is your down payment plus your closing costs. All right, so if you stuck with me, then if you were with me through this section, then you'll have an explanation for most of these things over here on the 20% down. So I'm not going to give a detailed explanation like I did before, but I'm just going to run through the numbers here. 20% down, we're seeing a monthly payment of $3,333. We no longer have mortgage insurance. We had mortgage insurance over here. We no longer have that because we hit 20% down, which automatically knocks off $195 per month of costs. And then obviously our principal and interest is going to go down because our loan amount has gone down. Now, these two are not the same. Homeowners insurance, they are not different. Homeowners insurance and taxes are not different because the house is still the same. The house has not changed, and these are dependent on the house. They're not dependent on how much you put down or your loan structure. So the last component is just principal and interest, which is $2,901 per month, which is a function of your loan amount and your interest rate. In this case, our interest rate did not change just because we went from 3% down to 20% down. Sometimes it might. Higher down payments sometimes get you better interest rates, and in this case it did not, and that's just going to vary depending on the market, depending on the loan program, and various things like that. But we have an interest rate of 7.375. Again, not an advertisement, just an estimate for where we're at right now. Again, this is just your principal and your interest. It's your monthly payment, not including the things that are dependent on the house. It's just your monthly payment from the mortgage perspective, which is $2,900. And then points or credit. In this case, we paid $80 of points in order to get that interest rate of 7.375. But again, that is functionally zero. It's basically zero. It would take several $1,000s to move the needle on this interest rate. 30-day lock, no prepayment penalty, lender fees the same, and then other closing costs of $10,436. This time it is slightly lower because our loan amount is slightly lower. We're at $420,000 instead of $500,000. And that's offset a little bit because now instead of receiving $158 of credit, we are paying $80 of points. Otherwise, this would have been even more different from over here. Now, estimated cash to close then is our other closing costs plus our down payment of 20% means you'd have to bring $116,626 of cash to this deal in order to get this house. So let's talk about how much income it would take to qualify. Now, it's gonna the way that lenders figure out whether you can qualify for a house is not really based on the house purchase price for the most part. It's a factor, but only indirectly. The way they figure out is based on the loan amount and it's really based on your monthly payment. So what that means is the qualifying income is going to be different for each of these scenarios. The income it would take to qualify for this loan is different in each of these scenarios. Now, before I keep going, I should address that I'm talking about your qualifying income. I'm not talking about how much you should budget. I'm not talking about how much you should feel comfortable taking on, how much of a monthly payment you should feel comfortable taking on based on your income. I'm just talking about whether the lender would approve you for this loan, whether you would be able to take on this loan. Whether you decide to is another thing. I am curious to hear what your rules are for yourself, what you think the best percentage of, would you be willing to let your monthly payment be more than 25%? That's a common rule. 28% is another common number. Some people are more comfortable with getting closer to 40% of their monthly income. How do you think about what your budgeting should be on that? I have some thoughts that I use personally, but I'd be curious to hear in the comments what your approach is on that. But I'm going to get into here how the lender figures out whether they would approve you for the loan. And so the key concept that is used is this idea of your debt to income ratio. And your debt to income ratio is your total monthly debts divided by your gross monthly income. And this number this ratio is the most important thing that lenders use for conventional loans specifically to figure out whether you can qualify for the loan. So it is very similar with FHA. In fact, the calculation is the same with FHA, but the number that they use, the number they allow is slightly different. And I'll explain that in 1 second. VA is not really, it's very different how they determine what you can qualify for. But your debt to income ratio is your total monthly debts divided by your gross monthly income. And your total monthly debts is your new proposed housing payment. So the housing payment that would result from this loan scenario, plus any other monthly debts you have, credit card, student loan, car debt, all that. All of that added together with your new housing payment that you're trying to take on. And they divide it by your gross monthly income. And this number needs to be, I always do that, this number needs to be less than 50%. Less than 50%. If it is less than 50%, then most of the time within conventional, that's all you need to check out. You can take on the loan. I will talk about what income that would mean here. You can do the math quickly in your head, but I will talk about what income that would mean here for these scenarios then. But one note on this for the gross monthly income is that it needs to be income that qualifies in the lender's eyes. The number that they use here is not necessarily the same number you have in your head. The way that they figure this out is sometimes just a very confusing process, a very rigid process, the way that they figure this number out. They don't just ask you how much you think you're making. If you are salaried, then this number is usually pretty easy to figure out. If you're entirely or almost entirely salary, then this number is usually just whatever your salary is, and that number is usually entirely usable. But if you make income in other ways, if you are self-employed and your income varies in that way, if you work on commission mostly, if you're in sales and you make mostly commission, or if you work variable hours and the amount that you make 1 month and 1 year could vary a lot, and there's no clear expectation of what to expect, or at least there's no guarantee. If you're variable hours like that, if you're any of those, then the way they figure this out is pretty rigid, and you're not really going to know what to expect until you just go talk to a loan officer and show them kind of your payment history. They'll look at, depending on your income type, they'll look at various documents. It might be tax forms from the previous years, it might be pay stubs, but they'll typically take some evaluation of the past few years, usually the past 2 if you're any of those types of payments. And then they'll figure out what this number is. But whatever number they end up using, your total monthly debts divided by that number needs to be less than 50% in order to qualify for the loan. So in some cases, it could be not at all close to what you think you're making, if as far as the number that they use down here. So that can make qualifying sometimes difficult if you work in any of those pay structures and you haven't had a lot of history in the current position you're in, or at the current amount of income that you are making. So if that is you, I'd highly recommend, feel free to put any comments here and ask questions, or reach out to us directly. But I'd highly recommend just reaching out to a loan officer and having them look at your income and see what you might qualify for. But if that is the rule, that your total monthly debts needs to be less than 50% of your gross monthly income, then let's figure out what the gross monthly income required would be in each of these scenarios. I'm going to assume you have no other debts. I'm going to assume that your only debt is going to be this new housing payment. So if you do have other debts, you just have to add it to this top number. But I'm going to assume you have no other debts, so we're going to use just $4,145, and if that is the number that has to be less than 50% of your gross monthly income, then your gross monthly income would need to be at least $8,290 per month, and in this scenario would be $6,666 per month. In order to qualify for the loan for this monthly payment, you'd have to be making $6,666 per month. In this scenario, $8,290 per month. Again, let me know what you think in the comments, what you think is a good range. I'm not recommending, again, that just because you make this, you should take this payment on. I'm just saying that this is what a lender would need to see in order to qualify you for this monthly payment. Again, let me know in the comments if you have a good rule that has proved helpful, or how you figure out what kind of monthly payment you'd be willing to take on. If you want to get a sense of if you want to get a quote on a house that you are looking at, on an actual house, and get a look at your numbers, or if you just want to have someone look at your income and tell you how much house you might be able to qualify for, please do reach out. We are a mortgage broker based in Bothell, Washington. and we do loans in Washington and Idaho. So please do reach out with any questions. All our contact info is in the description below. There's also a link there to watch a couple videos of what it's like to work with our team. We want to provide a great process, and we want to make sure we're a good fit with our clients. So if you watch those videos and read any reviews and it looks like we are a good fit, please do reach out. We'd love to work with you. All our contact information is in the description below.